Financial Planner. Follow us on YouTube.
Warning, economic breakdown headed our way. Let's get into the economic collapse financial news. Now, a couple of reports back, we talked about how China, how they were locking down the exchanges for the cryptocurrency, and they were saying that they were going to ban trading. And what we're seeing right now, that there's a lot of confusion. Now, I don't know if this was a report that was put out there to scare everyone, to bring down the price of Bitcoin, but what we're seeing right now is, even though allegedly they're saying that they are planning to ban trading of Bitcoin and other virtual currencies on the domestic exchanges, the actual three biggest exchanges, they still have not received anything official in regards to the ban. And Russia is out there, and they're saying that there's really no point in banning cryptocurrencies. Now, again, was this a story that was put out there to scare everyone? We don't know as of yet, but we can see right now, and we understand that certain individuals in countries, certain central bankers who are running the monetary system, they don't want the cryptocurrency to be open, to be free, to be decentralized. They want control of the system completely. And this is maybe why they decided to come out and put out this story, to make everyone think that, oh my God, look what's happening here. It's already being banned in many countries. We should get out of it. But we can see right now, none of the exchanges have actually received any type of notification. Now, what's very interesting is that the Fed is out there, and this is Fed Reserve Governor Lyle Brainard. He's out there saying that, let's take a look at the overall everyday average Joe, and let's see how they're really doing. And again, when we think of the economy, we think of GDP. This is what the corporate media is pushing out there. This is what the government is putting out there. And when we really look at the economy, we can see that there's a lot of problems in each of the economic sectors. Now, they're looking at unemployment, they're looking at GDP, they're looking at the stock market, and what they're saying is that, yes, the U.S. economy is on solid footing, we don't see any type of problems, and everything looks fantastic. And of course, now we have the unemployment rate down very, very low, but what we see happening right here is that real wages and salaries, they've been declining. Unemployment, it is completely manipulated. If we use the old calculation, and this is coming from Shadow Stats, we can see that unemployment is around 22-23%. Now, what's very interesting about all of this is that the ratio of spending to income has been very elevated since September 2016. Now, there have been only 3 extended periods in history where the ratio of spending to income has exceeded 0.92. This is the months surrounding 2001. We know what happened in 2001. We had a recession. From 2004 to the beginning of 2007, well, we've seen it back then, and we were in a recession in 2008. Here we are, since September of 2016, we are seeing the same exact thing. This tells us that something is going on because we've seen this pattern before. Now, we've looked at many different patterns, and we are seeing very similar patterns in each one of the economic sectors, which shows us that we are approaching some type of recession and things are not normal. Now, personal savings, they have hit historic lows, which tells us another thing. All these unemployment numbers where they're saying we're at full employment and everyone is enjoying this recovery, well, why aren't people saving? I mean, if they all have these jobs and everyone's doing great, why is the savings rate continually falling? Now, we've been seeing the savings rate continually fall since 1970. It popped up a little bit around 2008, 2009, 2010, and this was the very wealthy accumulating a lot of wealth. But since then, we have been on this slide and this decline slide for a very long time, which shows that the wealth effect, where all this wealth is being pushed up to the very wealthy. And what we're seeing right now is that the American middle class, it's been rotting away for decades. And if we go back in time, like I said, all the way back to the 70s and before that, before the 60s, we can see that wages and salary as a percentage of GDP is continually falling. Now think about this. Going back to the 70s, the wages and salaries as a percent of GDP was around 51% or so. Throughout time, it has fallen, and here we are in 2017, and we are down around 43.5%, which shows us that something is wrong. And all throughout this period of time, yes, we had little bump ups, but the decline, well, it's continually moving downward. And we can see that the top 0.01%, they have been accumulating all this wealth. And basically what has happened is the bottom 50% of income earnings is continually declining, and the top 1% of income earnings is continually increasing. So we can see we have major problems in the economy. The wealth is being stolen. We can feel it. We can see it. And the economy is not doing as well as they want us to believe. Now, out in Spain, and we're seeing a lot of this out in Italy, out in Spain and Germany, where banks are running into trouble. Now, remember, they have these stress tests. They want us to believe that everything is fine. And what we're finding out is that these banks are in trouble. They're having quiet bail-ins, quiet bailouts, and one bank is saving another. And we see another bank that is in trouble in Spain. Now, Liberbank, this is Spain's 8th largest lender. It was spawned in 2011 from the marriage of 3 failed saving banks, and now this bank is in trouble. So we can see with Banco Popular and many of the others, they're all running into the same exact problems, and it looks like the domino effect right now is happening, where each bank is rolling into the other and each one is failing. Yes, they can prop them up for a short period of time, but as time goes on, it's going to get worse and worse. We see Citibank, the Citigroup CFO John Gersbach, he is warning investors that there's problems where they're going to see revenue. Now remember, revenue and earnings, two different things. Revenue is going to tumble by 15% in the third quarter. And it's not just Citi, it's many of the other banks. Now, major corporations, we can see they don't have revenue coming in. Yes, they're closing different plants, they're buying back their stocks, they're letting people go to make their earnings look much, much better. But sales, revenue coming into the company, this is something you cannot hide. And they're already out there saying that this is going to drop and we're going to see revenue drop by 15%. Deutsche Bank is out there. And the latest from Deutsche Bank's model, which looks at the economic data, they are reporting now, and we reported on this before, that we are approaching a recession. They're saying the recession is going to start within the next 12 months. And we see right now that we are definitely running into problems. Now, we've been looking at all the different economic sectors, and we've been looking at these patterns, and a lot of them are showing that, yes, we are in trouble. Now, one of the more important ones is commercial in industrial loans. Now, we've talked about this before. We talked about many other economic indicators, but the commercial and industrial loans, what we're seeing right now is that this is a guaranteed leading indicator of future recessions. And what we're seeing right now is the commercial and industrial loans, they've hit a peak and they're starting to come down. Now, if we go back to the 90s, we saw this happen. We entered a recession. If we go back to 2000, we hit the same type of peak. We entered a recession. We go back to 2007. Guess what happened in 2008? We went into a recession. Here we are right now. The pattern looks exactly the same, and it looks like we're moving into that recession period. Now, Steve St. Angelo, who runs the SRS Rocco report, he's out there and he's issued a major warning that the markets, well, they could be declining by 85%. And he goes back in time and he talks about, well, what happened back in 2008, where everyone thought the subprime securities, everything was fine and everything was going very, very well until it didn't. And he says if we look at the central banks, they've purchased $2 trillion in assets in 2017, and we looked at this before. Now, he said so far in 2017, and we know this because we reported on it, there's been a 1.96 trillion of central bank purchases of financial assets in 2017 alone. Central bank balance sheets have grown by 11.26 trillion since Lehman to 15.6 trillion. Now, we talked about that before. Now, he said what is interesting about the nearly 2 trillion in central bank purchases so far in 2017 is that the average for each year was only about 1.5 trillion, which can plainly see that the central banks had to ramp up their asset purchases as the Ponzi scheme seems to be getting out of hand. So they increased their purchases, they increased their balance sheet, they did not shrink their balance sheet like they said they were going to do. Now, he goes back to Bear Stearns' during that time period. And he's saying that, listen, a lot of people forgot what happened back in 2008 with Bear Stearns, where the whole thing just fell apart, where Lehman, the whole thing fell apart. And he said that, everything is fine until it isn't. What they do is they keep the illusion alive, making you believe that everything is fine. Look what they did back in 2008. Let's not forget this time period, because it's very important not to forget, where they told us the subprime securities were AAA, everything is contained, they're not forecasting recession. They do this on purpose to make everyone believe that everything is going to be great, everything is fine, and they've done this once before. Now, remember, Bear Stearns, they lost around 98% of its stock price in a little bit more than a year. That's how fast and how quickly it started to fall apart. Lehman just closed down. Now, he's saying, let's look at the volatility index, which is the VIX, and let's see where we're at right now. Now, this is showing, and it's signaling that the big markets, there is trouble ahead. He says the VIX, the volatility index, is shown to be at its lowest level ever when compared to the S&P 500 index, which is at its all-time high right now. Now, if we look at the VIX index in 2007, it fell to another extreme low right at the same time Bear Stearns stock price reached a new record high of 171. Isn't that a neat coincidence, he says? And we're seeing the exact same pattern. Now, everything that we look at is pointing to one thing, that this economy is in major, major trouble. And we are headed down this path where all these economic indicators, they are pointing to the same thing. There is economic trouble ahead. I do believe that we are already in a recession. It started in 2016. And again, the government, the Fed, they're not going to report on this until it's much, much later in time, where they go back in time and say, yes, it did start during this period. Because we've been following everything, and we can see everything that we've been saying about the economy. Well, it looks like it's coming true, where we're seeing the deterioration of retail, the deterioration of housing. We're seeing that the manipulated numbers completely don't make sense, and these economic indicators are pointing to a recession collapse scenario. So if you haven't started to prepare, I would start to prepare now, because we're seeing a lot of these different signs, a lot of these warnings. And if you go back in time to 2006, 2007, there were many people out there saying, listen, we're heading into a crisis, a credit crisis, a housing crisis. And there were warning signs all over the place. The same thing is happening now. We are heading into this crisis. We are being warned. The universe is whispering in our ear, get ready, something bad is about to happen. And we need to understand that things are breaking down. I mean, remember, the dollar is dependent on oil, because they took the petrodollar, they placed it on oil, and what they did is they went to all these different countries and they made countries purchase oil using the dollar. Well, this is starting to fall. Actually, it's not starting. It is falling apart. And they cannot spread this any further. What happens when you can't do this anymore? And countries don't have to hold the dollar. And countries decide to take control of their natural resources, the way they sell their natural resources. Well, no one needs the dollar anymore. And the dollar comes back to the United States. If the dollar comes back to the United States, what happens? There are more dollars in circulation. We see inflation. Remember, the central banks have been offloading inflation to other countries, to other areas like the housing market, to the student loan market, to the automobile industry, to the bond market. Everywhere they could possibly do this, they've been trying to move it out of the U.S. But when these dollars come back, we are going to see inflation. There's no other way around this, because countries will not need to hold on to it, which means that it's going to come back here. The Fed, where they've been creating this stimulus, same thing with the ECB, they've been feeding this into the banks. They don't want this money out in circulation because they know it would be a complete catastrophe in the economy. And this is why they've been keeping it in the market, keeping it within the banks, keeping it out of the public's hands. They don't want it to reach the public hands, because that would mean there's more dollars in circulation. Think about it. The trillions and trillions of dollars in circulation, the value of the dollar decreases. It means that products will cost a lot more money. So we could see right now we are in this death spiral, and it's just going to pick up speed as we move forward.